This is Sheila Arthur. His favorite website is HassleFreeCashFlowInvesting.com.
This is David from HassleFreeCashFlowInvesting.com, and we've been talking a lot about equity stripping, getting the money out of your property to go do more deals. And what that does is it creates velocity. And that velocity is super, super important because when you're looking at return on investment, it's always compared to what? It's compared to a period of time, usually in years. So you're saying, well, I made a 30% return. Well, who cares? Over what period of time? If you made it over 30 years, that's not a good deal. If you made it in one day, well, that's an enormous home run, right? So that velocity of time helps us increase our annualized yield. And that's why equity stripping is so important. And so here is one way to do equity stripping. So let's say you go buy a property with 20% down and 80% loan from a bank, right? In order for you to be a profitable investor, your profit only comes once you get this 20% back. So if you never get that 20% back, you never made a profit, right? The sooner you can get that 20% back, the higher your velocity is, the higher your annualized rate of return is going to be. So how do we get this equity out? 80% loan to value is about the most banks will do, right? Maybe there is a private party, an individual, right, who would give you a loan against that 20% equity in your property other than a bank. And so, who might that be? Well, remember back a couple videos ago we talked about the lemonade formula. And the lemonade formula says that if someone is motivated to get rid of a lemon, they need your sugar. And for you, that 20% equity, that kind of is your lemon. So when you put your haves and your wants together, we talked about that in the last video, it's possible that there's a connection. And let's show you how that could be. So let's say you've got your 20% equity here and you want to get it out. And so here is Joe. And Joe says, I'm willing to give you a loan against that 20% equity. That's a pretty risky loan to go above 80% loan to value, or it could be risky. So why would Joe be motivated to make that loan? And the answer could be, well, it could be a high rate of interest, right? You could say, well, Joe, I'm going to pay you 30% annualized, and I've got a really good credit score to back up that loan. Well, that's one solution. But the ways that I really like are different than just paying a lot of money. Because if your goal is to make a profit, you can't always entice capital to you by chasing high rates of return. So maybe you go to Joe and you say, Joe, I know that you really want to access my time or my talent or my relationships, or maybe you've got a lemon that you want me to get rid of. So in a couple videos ago, we talked about the gentleman who owned the property in Kansas City. And so you might say, I will buy your lemon property if you give me what I want, which is a 20% cash out mortgage on an equity that I already have. And so that person, when you're adding something to the loan other than just cash, it creates an additional motivation to get the transaction done. In our next video, I'm going to show you how you can access equity very, very quickly and in a hassle-free way. See you soon.
Will you help me go to HassleFreeCashFlowInvesting.com?